So what are these used for? The slow average closed slope change is used because it implies a price trend change. Pretty much bet that ES is going to start to go down. Same way with up. You can also look at it to get an estimate for what the length of the up and down runs are. These things are only a relatively long stretch of declines like that took place. On the other hand, it changes colors 3-4 times in the space of 8 minutes. Your inside chop. The slow average close also gives you a feeling for where you are in the range seconds with regard to changes to upticks or downticks. Plus or minus 300 in this particular case is not very interesting because nothing's going on. There's just slow churn. You see that a lot during the middle parts of the day, and you see it a lot when the price tends to flatten out. If you watch ES on a tick chart, what you'll see are flat lines, and when those flat lines happen, there's just nothing of terrible interest going on. The second range, and the longer that you stay there, the farther and faster you move. You will see prices move at a fairly rapid clip in whatever direction they're trending when you're outside of that range. You also see an awful lot of activity that happens when you're way outside that range. When you're at 1,000 or so is the nominal number of people either sell into or buy into 1,000 ticks. It's also a reasonable measure of what I'd refer to as either enthusiasm or a lack of robots. Robots probably don't buy on a 1,200 tick, but they do sell on a 1,200 tick and a 1,000 tick. So when you get those really big tick numbers, it's likely that you actually have real people doing real buying and selling, as opposed to machines, because they'll tend to cut it slower and lower. High and low is part of the range. What it shows you is where it is that price has been in the past couple of bars. If you've seen sigma charts, standard deviation charts, multiple Bollinger Band charts, you get to the point where your eye recognizes where they're getting bigger or smaller. And when they start to get bigger, you're watching a ramp happen. When they start to get smaller, you're watching chops set in. And so you can look at that chart and actually see where it is that things get bigger or smaller. Here they're getting smaller, and you see this little wiggle, then they widen out by definition for me to visualize where it is that those numbers have been. The fast average close is probably the most interesting thing on here from stuff I haven't played with yet. Open, high, low, and close of tick. Crossovers, you recognize places where it is that this thing crosses over. Here it is that you're well outside of the range, and you can speculate that the next one's going to be well inside the range, and that'll be a crossover. That you can actually deal with trading minute charts. You get an awful lot of noise on this stuff. Really big tick bars, 900 points tall. They tend to be rare. I don't remember the way here to way here. Generally what I found is that when you don't generally see a 900-point change where you're going to go in that direction. I don't know why, but they just seem to be different. And so they're clues that something bad might happen, generally to me. Over is up and under is down. You'll hear me talk about it as tick is. It's the difference you are getting. Insert on the zero line, but it just happens too much. It causes changes to the cumulative tick and base time integral above or below the zero line. That's all it really is. And it tells you where it is the tick. Every time you cross the zero line, you wind up to try to stay on the right side of that indicator. You want to know when it is.